My name's Andrew Stotz from Maybank Kim Eng, and I was just catching up on one of my finance textbooks, looking into the concept of the efficient market hypothesis. For those of you who remember, there is the weak form, which basically says that historic information can't help you profit in the stock market. There's the semi-strong form, which basically tells us that new information gets adjusted to so quickly in the market that you can't profit from it. And finally, the strong form that says even insiders can't profit, because when they start trading, the market can see it and the market will move to adjust for it. Today, I'm going to talk to you about M&A deals across the world, and we'll talk more about the efficient market hypothesis. What we did is look at 4,600 deals across the world in every region, and we looked to try to find out, can investors gain by buying either the acquirer or the target company? Also wanted to look at whether value was added at the acquirers after the acquisition. We had $16 trillion worth of deals, and this was since 2000, and our deals were only worth over 800 million. Now you can see that most of the deals were in the West, in the US and Europe. Now how we did this study is that we looked at each transaction and looked at three parties: the acquirer, the seller, and the target, also called the acquiree. We analyzed the performance from the day of the announcement backwards and forwards. And we also tracked the forward fundamental or profitability of the acquirer over time. So what did we learn? Well, we learned that once a deal is announced, it's too late to profit from it. We also saw that rarely do acquisitions deliver improved financial performance. Of course, what was interesting is that we investigated the strong form of the efficient market hypothesis, and we saw that insiders could outperform if they knew to buy the target company. Of course, we know insider trading is illegal. This probably implies that either people saw the companies as targets for a long time, or it's possible that information leaked out from these insiders who have an obligation to keep that information confidential. Here's a look at the results of the study across 4,600 deals, and basically going back 180, 90, 30, or the day before the deal was announced. In each of these cases, you could have profited about 77% of the time if you knew that the target company was going to become a target company. But we don't know that. Only the insider would know that. So we're left with having to look at the post-announcement performance. So what we try to look at in this case is trying to understand, if you could buy post-announcement or the day of the announcement, would you perform better than market performance post that announcement, after that announcement? And we saw it's about a 50-50 chance. We also saw that rarely does the acquirer cause themselves to have improved profitability. And that's interesting because it tells us to be careful when we hear about synergy and improvement in profitability. Of course, we did see that earnings per share and book value per share increased, but that's because these companies are trying to get bigger. So we can look at it. This is from the announcement date. Let's say you wake up in the morning, read the newspaper, boom, it's announced, or it's announced the night before. The stock starts trading on that day, you buy it. What's your chance of outperforming on a 30, 90, 100 day, or on average of these? And on average, you've got about a 53% chance that you'd outperform if you bought the target. So it's better than 50-50, but it isn't exceptionally high. And for the other ones, you've got more of a chance to underperform. Now, if we look at the profitability, what you can see in this chart, I would highlight the number 63, which is all the way over to the right of the chart. 63% of the deals saw a deterioration in their profitability after the acquisition. Acquisitions do not cause profitability to rise. So be skeptical when you hear CEOs talking about things like synergy and improved performance. If we do look at growth, we can see that 45% of the time after the deal, or 45% of the deals after the acquisition announcement, we can see that earnings growth and book value growth grows by 45% of the time you get that growth. So it's pretty natural that you would get growth because these companies are trying to grow. Now we did look at the results, break them down in Asia, and they come out almost similar. And what we did see in Thailand is interesting. In Thailand, if you're buying the target company, you've only got a 23% chance of beating the market if you buy it on the acquisition date, or sorry, on the announcement date. And on that announcement date, the point is it's too late. And in Thailand's case, it's not 50-50, it's 23, which is telling us that the information is probably leaking out in the market long before the deal is done. And we see that only 12% of the time did performance improve as a result of acquisitions. That's a shockingly low number. So this is what I looked at this week, trying to understand efficient market hypothesis and its practical applications in investing. What did we learn? Number one, be skeptical when everybody's talking in the market about a deal that's already been announced. If it's already been announced, it doesn't matter anymore. Don't buy it. And also be skeptical if you think that the company is going to be improving its profitability over time. Unlikely that they'll do that as a result of acquisitions. That sums up the research for this week. Thanks for listening.